How is trading different from investing? There are many key differences between traders and investors, but let's not forget that they both have the same goal. They all want to make money. And this is a large reason why you're watching this presentation today. Let's not forget that. Okay. So investors focus on buying a stock or asset class and holding for a long period of time. These are generally buy and hold instruments like stocks, for example, the blue chip stocks, which also pay a dividend, and it's hoped that they'll grow in value or perceived value, and the market will obviously price that into its trading price, and this will happen over time, over a gradual period of time as well. And of course, these asset classes are very popular with people who just want to buy and hold and not really have a very complicated or active investor lifestyle or investor experience. Typically, such investors participate in fewer transactions than traders, and they'll go typically for days, weeks, or even months without even entering the market or even looking at the price of their stock or asset class they're looking at. So they're very hands-off, set and forget, and they'll sit patiently through market cycles, and with the understanding that pullbacks are natural, they do happen, and they're very much taking a longer term view. Their ultimate goal is obviously to sell their asset class, for example a stock, at a far higher price than they buy it at. That's the name of the game. That's where they look to make capital growth, and if their stock has a dividend, which many of them do, which is essentially a thank you or reward paid out on a yearly basis to investors for buying into that company, then that's an additional way of getting income as well as capital growth. So investors focus on buying an asset, possibly a stock, which has good fundamentals. They won't really look at it from a technical mindset as we do. They'll typically look at the fundamentals, for example, the PE ratio, earnings per share, look at the current ratios, and will make an assessment based on the health of the company. And this is generally over a longer period of time, like a year or months, for example, or several years. As I said, they'll participate in fewer transactions than traders, and they'll go for a long time without actually doing anything. So traders, we essentially place many more trades, and we can make money from markets as they both go up and go down. And we want to make as much profit as possible from every high probability move as possible. So whether a market is going up or going down or going sideways, we seek to take advantage of that. If you're an intraday trader, typically intraday traders place more positions than set and forget end of day traders like us, but then us end of day traders, us lazy traders, place more trades than these longer term investors. Okay, so intraday traders typically place several trades a day, whereas end of day traders can place several trades a week or even several trades a month. There's no real minimum trade threshold. We typically place a trade if we get a setup which fulfills our rules. We look to profit when the market is moving up and making down, and that's the crucial difference between investors who typically just make money from the markets as they go up. So we can benefit from the two-way street here, which is fantastic. It gives us essentially a lot more choice in taking advantage of markets which are depressed or bear markets. And the great thing about trading in a recession or in a crash is that markets move down a lot faster than they move up. So we can really take advantage of that rather than just watching in horror at our investments as they go down in value. Okay, so looking at this upward trending trajectory here, we can see that it's got a certain amount of predictability here. It's going upwards. It's making what we call higher highs and higher lows, which we'll talk about later on into the Lazy Trader course. And it would simply make sense to buy the pullback where we can see that it's very likely it's going to go up after it's come down, whereas we would look to sell the top of this swing high here as it's made in a very predictable fashion. A higher high, we'll take it back down to a higher low before buying, take it up to a higher high before selling, and take it down to the higher low, like so. Of course, we'll look at a little bit more criteria than this. This is just an example. Okay. So here are two different key people. You probably recognize their faces, who are very different in their approach to making money from financial markets. We've got the investor, Warren Buffett, who looks at the financial health of stocks, looks for value when buying, looking very closely at the fundamentals based on equations like, for example, earnings per share, the current ratio, and of course looks for stocks which pay a dividend. He apparently doesn't even look at a stock which doesn't pay a dividend, which is good for annual income. Whereas trader like George Soros, he has a little bit more of a complex technical view, where he looks to make money from markets as they go up and go down. And of course, this guy is famous for calling cable short when the British pound smashed out of the exchange rate mechanism back in the 1990s.